Well, let's take a look at the problems from chapter 12. So I've got problem 24 on the screen here. And this is a continuation of some of the work we did working on the exercises, but I thought the problems would be good to go over. I'm not going over all of them by any means, but we'll go over, I chose some of the ones that are very representational from the homework. So the first one I have on the screen is question 24. And this is the profit and loss statement of Kitch Ltd. S Corp. Shows $100,000 of book income owned equally by 4 shareholders. From supplemental data, you obtain the following information about items that are included in book income. So the selling expenses and tax-exempt interest income, dividends received, Section 1231 gain, depreciation recapture, net income from passive real estate rentals, long-term capital loss, salary paid to owners each, and cost of goods sold. So basically just do their separately stated income statement or a loss for the year. So separately stated income or loss for the year. And then recognizing that they start out with $100,000 worth of book income. So I've already got an Excel little spreadsheet built here to do that. So we'll start out with the book income of $100,000 that they gave us. And then we make some adjustments to that. And the one thing we add back is the long-term capital loss, which was $6,000. So I'm just coming back to here and showing you that right here. And then I subtract from that quite a few items. So I subtract from that dividends received, tax-exempt interest income, Section 1231 gain, and then the passive activity gain of passive activity income of $5,000, those rentals. And I need to subtract that, which my formula didn't work for me. So let's go ahead and subtract that. So I'm going to just do a minus here and subtract that. So I get to non-separately stated income then of $82,000. So book income, I make adjustments to that book income for all the non-separately stated items, and that gets me to what is the non-separately stated income. In other words, that's what will be split 4 directions. So that was question A. And question B then, what is the share of each person? It's 4 people who own this. And so that was letter A. Letter B is just simply taking this number and dividing it by 4. Okay, so letter B, the answer is 20,500. And then question C is, what is James Billings' share of tax-exempt interest income, if any? Is income taxable to him this year? So we go back here, and James is just one of the 4 equal owners. Okay, so there's 4 people who own it. James is just one of those people. And all we have to do is go back to the Excel and go find the tax-exempt interest income right there, the 3,000. Just simply divide that by 4. And then his share would be 750. And then the question, his share is 750. It's not taxable to him because it's tax-exempt interest, so it's not taxable. Okay, so he receives the income but does not have to pay any tax on that. So from that, let's go ahead and take a look at the next question, which is question 26. So I'm just going to skip 25, so we'll go down to 26. And 26 is kind of along the same lines. It says here that Zebra Inc. is a calendar year S Corp. Incurred the following items during the year. Sammy is a 40% owner of Zebra. So we're going to talk about Sammy's share of all these different items here. So we get to kind of the same thing here: operating income, cost of goods sold, depreciation, administrative expenses, gains, depreciation recapture, short-term and long-term capital gains and losses, and charitable contribution. So letter A is, what is Sammy's share of the non-separately stated income items? So I'm just going to erase the numbers that are here, and we'll use some of the same headings, but it's not exactly the same. So with 26, we start out with operating income. Right here it says operating income. Okay, and that actually happened to be 100,000. And then we add to that depreciation recapture. And we come back to here and we can see that depreciation recapture is the $25,000 amount right there. Okay, and that just gets us down to the new total, which is 125. Then I subtract from that a few items, and I'm going to actually erase more. I think it's easier just to erase these. And the items we have to go back and take a look at is I'm trying to get down to the non-separately computed income, but I started out with operating income, and then I add back the depreciation recapture. Then I have to subtract kind of just what's the general expenses that the company is incurring. So cost of goods sold of 40. The admin expenses of 5, and the depreciation expense of 10. So those three items are just relate to the business as a whole, the 40, the 10, and the 5. So let me just kind of type in a brief explanation of what each one is. So cost of goods sold, admin expense, and then finally depreciation expense. Okay, so it's those three right there. So let's go ahead and put in those numbers. It's 40,000. Oops, I did that right here, I think. Let me do that to the left here. Oops. Right here. It's 40,000. It was 5,000, and it was 10. Okay, so the sum of those adds up to be these right here. I want to subtract those, so I'm just going to just do times minus 1 just to make it subtract. And then that gets me down to my new non-separately income, and this is computed income in this example. So it's what we just computed, and that gets us down to 70,000. You can kind of see the math here. 125 minus 55 equals 70,000. Okay, and then the question is, what is Sammy's share? Well, Sammy is a 40% owner, so multiply 70 times the 0.4, and the answer is 28,000. So letter A, Sammy's share is 28,000. Letter B, calculate Sammy's share if any zebra long-term capital gain, if any. So take a look here at what's there for the long-term capital gains. Right here we've got the $15,000 long-term capital gain. So letter B is just simply 15,000 times the 0.4, and then we just get the answer, which is 6,000. Then question C is calculate Sammy's share of charitable contributions, if any. So take a look at the charitable contributions here, 4,500, and kind of the same story. We'll just do that one right here. So 4,500 times 0.4, and just do the math, multiply one by the other, and we get Sammy's share of being $1,800 then. Okay, then take a look at question 28. I'm skipping 27. It says here that January 1, Kinney Inc. and S Corp reports 4,000 in accumulated E&P and a balance of 10,000 in A&A. Kinney has two shareholders, Aaron and Frank, each of whom owns 500 shares of Kinney stock. Kinney's non-separately stated income, ordinary income for the year is 5,000. Kinney distributes 6,000 to each shareholder on July 1. It distributes another 3,000 to each on December 21. How are they taxed? And ignore the QBI deduction. So I talked about QBI in the lecture and how that, remember that QBI is new with the new tax law passed back in December. That's something that's was added. And so the chapter includes a little bit about QBI, and we're just ignoring it for this particular thing. Then we'll come back to question 29 here, which kind of deals more with QBI. Okay, so we're going to cover this question, but it on purpose says exclude QBI. It wants you to focus on something else. So what you have to do is kind of think through the numbers here that are given to us for 28. So I'm coming back to question 28. So the AAA is the 10,000. So AAA is 15,000. It's 10,000 in A&A plus the 5,000. So AAA is these two numbers together, 15,000. And then distributions for the year total 18,000, right? So two people own the company, and they received two different distributions, 6,000 each, and then 3,000 each. So this is 12,000, and this is 6,000 for a total of 18,000 worth of distributions. Okay, so think of it from that perspective. So 15,000 AAA, the 10 plus the 5, and then 18,000 of distributions were paid out. Okay. Now the key part though is you have to take each distribution by itself. Okay. So let's look at the first distribution, which was on July 1, and that was the 6,000 paid to each for a total of 12,000. And then remember that the total distributions were 18. So I'm just going to put in, let me get a blank area here. So 12,000 over 18,000. So 12,000 is what was paid on July 1. 18,000 is the total. And then I multiply that by the total AAA. And the total AAA is 15,000. So I'm going to take 12,000 and divide that by 18,000. And then I'm going to multiply that times the 15. Okay, and that will give me a number that will help me get to the right answer. Okay, so just imagine then 12,000 divided by 18, and then I'm going to multiply that by the 15. I'm going to put some brackets around this, so around the 24 and around the 23 right there, hit enter, and I get 10,000. Well, I know that I paid out 12,000 on that date, right? So 12,000 is what I paid that date. And so the difference between the two, between 10,000 and 12,000, then becomes $2,000. And then, of course, that's divided by 2. So because there's two people, so each person essentially receives, just think of it as being a positive number now, $1,000 dividend. Okay, so that basically it's taxable as $1,000 dividend to each person. Then I kind of do the same thing for the last distribution. So the last distribution, the one done on December 21, that was 3,000 each for a total of 6,000. So this becomes 6,000, still times 15, and kind of the same story. But then here, instead of subtracting 12,000, I subtract 6,000, and that's $1,000 divided by 2 is 500. So the second distribution, each pay a dividend of $500 each. Okay, so everything else though was tax-free. So they can get up to their AAA balance back tax-free, but anything above that then is a dividend. Okay, so they'll pay 1,000 from July 1, 500 from December 21 dividends each. Okay, and that's really how they wanted to know what was each person's individual situation. Okay, coming to 29, that's the QBI question I was mentioning. So this one says here, McGlynn is a calendar year S Corp. His AAA balance is 0. McGlynn holds 90,000 of AEP. Tobias, a sole shareholder, is an adjusted basis of 80,000, and in his stock, determine the tax aspects of the 90,000 salaries paid and ignore the QBI. Actually, I'm sorry, I got that wrong. The QBI, I think, is question 30. Yeah, I'm sorry, I messed that up. Question 30 is the QBI question. So we're ignoring QBI again. And then letter B, a same part as A, except now he takes a cash distribution from AEP. Okay, so McGlynn is calendar year S Corp. AAA is 0, holds 90,000 of AEP. Tobias, the only owner, has an adjusted basis of 80. Determine the tax aspects of 90,000 salary is paid to Tobias. Okay, and this is something we kind of actually looked at, like with the LLCs and partnership stuff. You can kind of imagine how that works, right? Tobias recognizes ordinary income because it's salary, right? So he's going to treat that just like ordinary income and pay whatever his normal individual tax rate is. Because that was salary, then McGlynn's the company, they're going to incur that much more expense. And so that's going to be deduction, which means the expense is greater than the 80,000 basis, which means there's a $10,000 carryover loss, and his basis will be zero. Okay, so his basis goes to zero because of the loss, and 10,000 then is a loss carryover. Okay, so that's if it's salary. Letter B, now the difference will be he's going to take a cash distribution. Okay, so if he receives a cash distribution, that now is dividend income. Let me say that right, because that matters. Dividend income. And remember, the tax rate will be much lower than if it's ordinary income. So that would be taxed at most likely 15% would be my rough guess. We don't know exactly this whole situation, but that'd be probably 20% max, but maybe probably 15%. And then there's no deduction pass through, and he has a 80,000 remaining stock basis, but his AEP goes down to zero. So the AEP goes to zero, his basis stays intact at 80. Okay, so that's what the difference is between the two. Okay, now question 31, which is the last one that we'll do, and this is the one that deals with the QBI. Okay, so Jack and Mary are a married couple. Report taxable income of $280,000, which includes $200,000 from Jack's solely owned S Corp. The S Corp paid wages of $100,000 to employees, which does not include his salary. Calculate the couple's QBI deduction, if any, and no acquisitions of depreciable property were made during the year. Okay, so this is that special kind of QBI rule that's newer. This is, in fact, this is probably really the only major change from previous, what I would say would be the previous time this from a year ago. Basically, is the QBI stuff didn't exist a year ago, so now it does. So the QBI, recall, the reason it's there is to allow pass-through business entities to benefit from the reduced corporate tax rates, because that 21% applies to C Corps, but for LLCs and S Corps, they don't get a benefit from that unless you use the QBI. So the QBI was put into place to make sure that the pass-through entities are able to take advantage of the reduced tax rates. So there's some rules around that we have to be very aware of, and there's kind of a lot of ifs and thens. But page 12 of your chapter is where you would take a look at. There's a really good chart there. It's section 12-3B on page 12 of your chapter that explains that really well. So I'll just walk you through what the answer will look like. So the limit, and there's always limits on these things, they have a limit of $300,000. I'm going to get down to a blank area here. And actually, I'm sorry, I said 300,000. It's actually 315,000 for a married couple. Okay, so there is a QBI limitation for a married couple of 315,000, and they're married, and we have to worry about that. Their taxable income, if you go back to the question, was $280 right here. Okay, so the limit's 315. Their taxable income is $280. So far so good. So they can compute it. So it's the smaller of. Okay, that's the hard part here, where it's a little bit challenging. We have to put in the smaller of, and then we'll just do item 1, which is 20% of QBI of 200,000, or which basically is 40,000. Okay, so go back to the question, and right here, the 200,000 worth of income from the S Corp. Okay, so that's 20% of that is 40,000. So it's the smaller of 1 or 2. Okay, and 2 then, which this is kind of how it's worded kind of strange. The smaller of 1 or 2, Well, 2 is the greater of two things. It's the greater of, and we'll go with A, and that is 50% of W2 wages, which were $100,000. In the problem, they had mentioned that this was $100,000, which we all know equals 50,000. Okay, or whoops, B, and B is 25% of 100,000 again, plus, and the plus is 2.5% of the unadjusted basis of qualified property. Okay, so 2.5% of the unadjusted basis of qualified property, which is never mentioned in the question. There's absolutely no mention of that kind of property. Okay, so we can just assume that 0. I'm sorry, right here. It does mention that. I'm sorry, right here. Okay, so I can just say that 0 because of that. Plus 0. Okay, so that number, I'm sorry, I should have finished that up. So basically that equals then $25,000. Okay, so the smaller of 40,000 or the greater of A or B. Okay, well, this is 50, that's 25, so I can choose the smaller of 40 or 50. Now, obviously, we all know the winner here is going to be 40,000. So the answer is 40,000. Their QBI is 40,000. Okay. And this takes us way back. I mean, this is the stuff we covered the first week of class. But just as a reminder, then it's on page 12 of chapter 12. So it's on page 1212 if you need to look at that. So when you get a question or two from the homework that deals with that, go there. Okay, that's it. I hope that all made sense. As always, if you have questions, just feel free to let me know. Thanks.